Welcome. I'm Kevin Ahern from Standard & Poor's, Analytical Manager of the North American Property Casualty and Reinsurance Group. So on behalf of PwC and Standard & Poor's, we welcome our esteemed panelists. I do have a couple of public service announcements in advance. I think people are maybe wondering how we had the opportunity to come down to this venue. Our previous venue is under renovation, so more to come on that going forward. I also thought it was ironic, the title of this panel is called Navigating the Course, so what better way to help navigate than having a beautiful yacht out as well. And so that, unfortunately, is something you could go back and maybe tell some of your family members, but it does impact some of the beautiful skyline that we're used to seeing as well. So with that, another public service announcement. Bathrooms are to my right, behind the white covers on that front, so feel free to use them as possible. And then I guess the last public service announcement is that following the previous panel, Standard & Poor's does actually rate startups, and we are, once they gave me the mic, I had to take advantage of that. But seriously, we continue, and I know we put some commentary out there. We continue to look at those particular structures, and again, we're very open and continue to have interactive discussions with a number of those players, and hopefully we'll be putting out those ratings over the near term as we continue to develop our analytics on that front. And the good thing about Standard & Poor's is that we've been looking at hedge fund in terms of just hedge funds analysis in our primary sectors for a number of years, and it's having those analytics that will allow us to marry those up with the liability profiles of the startups that we're seeing, and potentially some of the captives that we're hearing about. So with that, without further ado, I'll turn it over now, and I can ask questions to the esteemed panelists. We're very fortunate to my immediate left to have Mike McGuire, who is the CFO of Endurance. Mike has held that position for 8 years. He has spent over 11 years in Endurance and previously held a number of public accounting positions in the sector. So it's a great pleasure to have Mike on board this morning as well. In the middle, we have Joe Henry. Joe is the CFO of Axis. He's operated in that position for the last 2 years. Previously, Joe held a similar role at Excel. Again, significant public accounting experience, and Joe has been in the insurance sector for the past 25 years. And then also to our left is Jason Porter. Jason is the director at Standard & Poor's. We're fortunate to have Jason on our analytical team. Jason's been with us for a few years and previously was an underwriter at Navigators, where he looked at a number of professional liability lines as well as D&O. Unfortunately, within your packet, Bill Babcock of PartnerRe unfortunately had a last-minute conflict, and Bill will not be able to join us today. So with that, we had the other thing I was actually going to mention in the public service announcement is wanted to have the audience interaction, but you really stole the thunder in the last panel. So hopefully that will continue, and I'll give you 15 minutes, kind of a 15-minute warning when we're ready to go out for questions. So with that, we had a number of strategic discussions this morning around the excess capital, around the growth opportunities, and I think it's best that if we turn over to Joe initially and talk about the various different challenges that capital deployment has given this market, understanding the cyclicality, as well as opportunities in terms of other sectors outside of, say, NatCat, that we have the ability to deploy capital. So, Joe, how challenging is this market to you?
Well, as you heard before, and good morning, everybody. Good to see some faces that I've run into in the past. Also good to see my staff. I was in the office this morning wondering where everybody is. They're here. But in any event, I'm not sure how Mike feels about this, but I think one of the biggest challenges that I have is how to look at deployment of capital. At Axis, we really look at 3 or 4 things. The first is, can we put it to work in the business? Clearly, that is our preference. and I'll come back to that in a minute. Secondly, it would be, can we make some investments, I'll call them some strategic investments, and I'll describe that in a minute. The third would be M&A. I was wondering where all the investment bankers were for the first 2 years that I was with Axis, and all of a sudden I found them in the last year. It's been amazing how many meetings have been requested, and we don't say yes to all of them, but frankly, it's been a lot more active. I'll come back to that. And then last, it's returning capital to our shareholders in the form of dividends and in form of share buybacks. And maybe I'll go in reverse order. We've actually been pretty active on the share buyback front this year. Generally, our policy is to return our operating earnings in dividends and share buybacks, and through 9 months this year, we've actually bought back more than that. And it tells you a little bit about the state of the market. On the M&A front, as I mentioned, there's a lot of activity there. Frankly, nothing has crossed our desk so far that really has crossed, I'll call it our strategic filters, the things that we look at. The third thing would be strategic investments, and we've actually made a few of those. And these are investments in third-party administrators, MGAs, maybe third-party capital that really are strategic in terms of locking in that business in the long run. And then the fourth would be putting the capital to work. Ironically, we just finished our 2015 planning process. And there are a number of opportunities out there, particularly on the primary side. I know this is more of a reinsurance conference, so I'll talk more about reinsurance. Reinsurance is pretty difficult. There's no doubt about that. You heard that on the last panel. But even within that, whether it be certain products, whether it be certain geographies, whether it's an ability, frankly, to grow with existing clients, we see a number of opportunities out there actually to still grow in a difficult reinsurance market. So maybe I'll leave it there, Kevin.
Thanks, Joe. Mike, do you want to add?
Yeah, sure. I wouldn't disagree in terms of the prioritization of how you utilize capital and where you deploy it. First and foremost, for Endurance, our focus is deploying capital in the business. I think it also helps, depending on where a company is in its life cycle. And although we are of similar lineage in terms of time of formation, we have a bit of a ways to go to catch up in terms of where Axis's footprint is geographically and by product line. So we spent the better part of the last 2 years substantially investing in the build-out of our underwriting capabilities globally. And we do find very good opportunities more on the insurance side than reinsurance to deploy capital. We are sitting on a decent excess capital position because even as we've been adding underwriting resources and adding business, we've been buying more reinsurance. Certainly the softness in the reinsurance market facilitates that. But if I look at the peak consumers of capital on the balance sheet, catastrophe risk is a key one, and that's an area over the last few years that we've been reducing our net retentions there. Our gross limits profile is about the same, but we've been increasingly buying retrocession, reinsurance protection against those portfolios. As the markets are softening, I think it's quite important to manage the balance of the portfolio and the risk profile, because frankly, we're getting close to the point in the cat space where the return profile just does not support significant retentions. And so we are maintaining our front footprint, but we're ceding a fair bit of that business away to protect the net position. I think the next time we see a series of big events, I think you will see some differentiation among companies out there in terms of their performance, those that are viewing the soft market as a time to increase retentions, or those that are viewing the soft market as a time to rationalize and control the risk and reduce their net retention. So it'll be very interesting to see post-event what happens. So first and foremost for us, deploying capital to build our business organically is a key focus for us. And for the next 2 years, we think we have more than ample opportunities across our insurance and to a lesser extent our reinsurance portfolios to grow the business. How much we retain will be a key variable in terms of what capital is ultimately consumed. The second piece would be investing in teams and buying businesses. I don't think it's any secret that Endurance has been a little bit active in the M&A front or trying to spur some activity. And we continue to focus on ways that we could accelerate our strategic development and growth as a company. We are in a world, and I think we'll get to it a bit later in terms of the regulatory overlay, that scale and size is going to be quite important to be a relevant global competitor. And we're clearly on a path to achieve that, but we're still, I think, 2 years away from being where we think we need to be from a size and scale point of view. We have the right people, we have the capital, now we need to see the business come through, and we're starting to see that. I think the noise that often comes from short-term investors when they talk about capital management and capital deployment, that's a veiled way to say how much stock are you going to buy back this quarter and how much are you going to buy back the next quarter. And I think I don't want to say it's a last resort part of your strategy, but that's really the last port of call for us. It was very important for us in our early development as a company as we migrated from being a privately held, venture-backed company to being publicly held. We utilize share purchases, a very effective way to right set our shareholder base to be broadly publicly held. Having done that and completed that, we now need to look at what are the ways that we can expand and diversify our business for the long-term benefit of our shareholders, not just what kind of short-term bump you might get from a buyback today that there's diminishing return in that going forward.
Great. Thanks, Mike. It's interesting, and this is not only the two companies that are represented here, but we do hear constantly the pulling the last lever, which is the share repurchase. So I think credit to the industry that they do look to deploy and reinvest, into their main businesses, and then it really becomes opportunistic in terms of the available capital that they have. Jason, maybe following that particular point, can you maybe speak to our view of the level of capital and its sustainability at which we would all agree is probably in excess?
Yeah, so the industry, as we see it, is pretty well capitalized. There are a number of companies that obviously have excess capital, and to their points, it comes to the question, do you deploy that capital? Do you return it? Do you deploy it in reinsurance? Do you deploy it in insurance? Do you deploy it through M&A? And we've seen companies take some of those types of strategies, whether it be M&A or investing in the insurance business. But the thing is that with excess capital, and the pressure on rates, it also puts pressure on ROEs. And as Kevin mentioned, it is one of the levers that companies have to improve their ROEs. So, with excess capital, we have seen certain companies, not all companies, but a handful, start look a little more closely at their excess capital and saying, how much excess capital do we really need? Earnings are coming in. They've been pretty good over the last few years, and they're trying to return it. And the question is, do we return more? Do we get our capital base down a little bit, maybe improve our ROEs a bit, or do we try to deploy it? So I think that those are the tensions that companies are managing. I think that it's potential that maybe the true absolute levels of excess capital might be slightly less in the future, but I think it's sustainable position that the industry remains well capitalized.
Thanks, Jason. Moving to investing in the business, Mike, you had mentioned that clearly there's a certain scale aspect there, but when you look within your chosen markets, can you discuss the opportunities that exist? I know you may not be able to heard the opening comments, but we were kind of talking about a new normal, about a 9% of the return on equity. But in essence, that's somewhat very difficult to achieve in today's market. So, is there an element of building out scale or leveraging that diversification so that you can have accretion in those returns?
I think anybody that says that they can generate a strong double-digit return on equity consistently is probably taking more risk than you think they are. In this environment, I think it's very difficult on an expected basis to generate very strong double-digit returns. Clearly as an industry, I think that is a level of returns over the long term that is required for our business given the volatility potential. But in the current market with interest rates where they are, I think that is a daunting prospect to get to double digits. As I look at our businesses, what we're trying to do is accumulate a portfolio of insurance and reinsurance risks that gives us the best chance of achieving that double-digit return. But I think in the near term, I think you need several things to go right. You certainly need your balance sheet to deliver strong results in terms of your reserve emergence. You need decent asset performance. And sometimes it helps to get lucky and not have an active cat season like we've had this year. I think if we would have seen a very active cat season, I think the 10 to 12 to 13% ROEs that you were seeing out of Bermuda would probably have been in the 6 to 8 to 9% ROE, depending on the magnitude of the events. So as I look at growing our businesses, we're focused more insurance than reinsurance, frankly, given the market conditions. we think there's going to be more opportunities. And frankly, the insurance market is a bigger, more fragmented market globally that provides more opportunities for a company to build scale, build capability, and actually have a portfolio and a business that is more sustainable. Reinsurance does suffer from capital flows. I'm sure the guys upstairs in the ILS conference and other areas are seeing that capital come in. They're desperate to try and find places to put it to work. And I think that pressure is not just putting challenges on underwriting margins. It's indicative of the challenges that asset managers have to generate a reasonable return on invested assets. We have the banks to thank for that in terms of the global suppression of interest rates. That's been a real challenge for our industry, and I think that's been a bigger negative impact on the ROE potential of our industry than the whims of the underwriting cycle, because we're used to underwriting through underwriting cycles. But the suppressed interest rates for long periods of time is something that the industry is just now coming to terms with.
Joe, you had mentioned that in terms of deployment of capital. You mentioned maybe even international diversification. You even mentioned some maybe the fee-based businesses. So it seems like based upon your business model that you have maybe a myriad of options, and maybe reinsurance right now may not be the particular time to reinvest. Yeah,
I don't want to downplay the opportunities, though, that are there in reinsurance as well. It might sound a little strange, but there are opportunities there. If you look at our business, we're about 50-50 between insurance and reinsurance, a little bit more on the insurance side than reinsurance. But when you break down our businesses, we have about 33, 34 businesses in insurance. We have about 13 businesses in reinsurance, and within our insurance segment, we have an accident health operation that is actually in 4 different businesses. So if you look across that, you've got 45, 48 different business opportunities. And frankly, there are some that are in a good position to grow, and there are others that, frankly, we've been shrinking for a number of years because the opportunities are just not there. Fee-based business, as Kevin has mentioned, is something that's pretty attractive to us. We started a weather and commodities business in our reinsurance operation a little over a year ago. It's been very successful for us. Frankly, as a CFO, I like fee-based business, especially when it doesn't drag a lot of capital with it. So whether it's geography or product or pushing a lever on the business opportunities that provide more profit, I would agree with Mike that the insurance side of the house presents more opportunities than reinsurance, but our reinsurance folks are pretty clever. And frankly, there is a flight to quality going on there as well. There's panels that are being condensed, and frankly, we're very happy that we're on those panels in terms of brokers and reinsurance, and primary companies reaching out to place their reinsurance with.
Great, thanks, Joe. Jason, again, given the fact that there's very few pure play reinsurers left, can you talk about how S&P is viewing these opportunities and looking at this emergence of the hybrid model?
Well, just to start off with diversification, obviously the risk reward in theory makes sense. You're never overexposed to one risk. And then also, as Joe said, there's a strategic advantage as far as the offering various lines of business. You can be more important to your cedents, and if there is consolidation in the panel, you can be positioned better. But speaking more directly to your question about going into insurance or even diversifying into lines of businesses or geographically, you always have to remember that profits are what diversify, not risk in and of itself. And then there's always challenges to diversify into new areas and remain profitable and actually have that diversification create a benefit for your organization. And the issues come down to expertise, or without getting into too much detail, there's regulatory issues, especially when you're looking at other markets or emerging markets, for that example. So those are some of the considerations, and over-relying on diversification is also a dangerous thing. And I think 2011 is probably an example that most of the people in this room are very familiar with, where some of the diversifying risk exposures were probably not adequately assessed on a standalone basis and created some surprises for a number of companies as far as the losses they produced and the amount of actual income they were getting for that risk.
Thanks, Jason. 2 common terms that we hear a lot in our ratings discussions is capacity over capability. And a lot of times when we're assessing our view of business risk profile, it does get down to capability and what people bring to the market. So we really look at that from a management execution standpoint. Joe, I know we just had a panel up here talking about the hedge fund back model, and the reality is that the asset side of the balance sheet is not historically providing the cushions that allow the underwriting teams to be able to demonstrate their underwriting capabilities. So given the low interest rate, given the low interest rate environment that we're in and a prolonged period of low interest rates, how has Axis looked at their investment portfolio, and have you stuck to your knitting with respect to diversification strategies?
Yeah, we really haven't made a lot of changes, frankly, in our investment strategy in the last couple of years. We have a new chief investment officer that just joined us a year ago, and a little less than a year ago. And one of the questions I asked him is, on the way in, I said, you know, you've taken a look at our portfolio, what would you do differently? And his answer was, not much. You know, if you break it down between the fixed income side of the house and the alternative side of the house, about 80% of our portfolio is in fixed income. And frankly, we need it there to match our liabilities. We take some risk on the alternative side of the house. It's about 18% of our investments. It really hasn't changed much. It's gone up, you know, a point or two. The mix within alternative investments has changed. Frankly, we were a little bit concerned about how lofty the equity market is, so we kind of backed away from that in the third quarter. That looked to be a really smart move in the last 2 weeks in September, and a really bad move in the first 2 weeks in November. But anyway, that's besides the point. But no, Kevin, you know, I just don't think it's a great idea, frankly, for an insurance company to take outside risk with their investment portfolio. And you know, our fixed income portfolio is pretty conservative. We've kept it intentionally pretty short. We're hopeful that at some point in time, interest rates are going to turn around. But I think, honestly, 2015 is going to be a very difficult year, you know, because the higher yielding assets in your portfolio are starting to run off, and your new money is just not generating the types of returns there. So, you know, if you're saying you're looking to bolster your returns from the underwriting environment on the investment side of the, you know, the house, frankly, we're not doing it, and I wouldn't recommend that anybody do that.
Mike, any additional thoughts?
Well, I'd say Murphy's Law is one that is, as soon as you convince yourself that investing in alternatives and equities is the way to generate the returns, you'll do that and have something happen bad, and then at the same time you have a CAT event. In terms of how we deploy our assets or deploy our capital, we're somewhat agnostic whether we take it on the underwriting side or the asset side, but the key theme throughout is, are you earning an appropriate risk-adjusted return for that element of risk that you're taking? And we've talked about it on the underwriting side. We're in a pretty soft market. We're finding some opportunities, but we're not in a hard market. And so you got to be very cautious. Something is very similar on the asset side. Look at where interest rates are. Spreads are pretty tight. Equity values are pretty high. Now is not the time to push more chips into the table, because you're going to be called out on that at some point. You may look okay for a year or two, but at some point, rates will go up, volatility will return, and you know, Joe talked about a few of those periods in the last month where all of a sudden we've seen a return of some volatility, and people have had some panic about it, but that level of volatility I think needs to be viewed as normal. The relative calm of the last several years after the financial crisis has been manufactured by governmental policy, and to think that that is a new normal and convincing yourself of that is very dangerous. And I think the hedge fund reinsurance companies, I think if they're using as a business model the backward view of their investment return post-financial crisis and projecting that forward, and then saying that they're going to generate low volatility underwriting business with a combined ratio under 100, I think they're kidding themselves that is a sustainable business model, because they're looking at the valuation bumps that came out of the financial crisis as something to project forward, and I think that is not a good way to project forward. So I'd be suspicious of that. I do look forward, though, to S&P's view of hedge funds and getting reduced capital requirements for investments and alternatives, because that is a key consumer of capital in the S&P view.
Absolutely. Well, good segue, Jason. So the debate continues. I mean, I know clearly there was a lot of great points brought up by the previous panel in terms of, you know, you can operate that model in a, you know, low frequency business aspect. But, I mean, Jason, to that point, I mean, you know, it's tough to make generic statements around the hedge fund backed model, but I mean, we've done an article on that as well. I mean, you just want to maybe hit the high points with respect of not necessarily that business model, but what are the key characteristics that we look at, and what are the avenues of analysis that we go through in terms of the hedge funds analysis?
Yeah, thanks. So, I mean, the hedge fund business model, obviously, you're going to have the underwriting risk and the asset risk, and the asset risk is pretty high, and the underwriting risk is theoretically relatively lower. So, you know, we don't have any ratings out into these companies, but when we look at the asset risk, you got to remember every hedge fund strategy is very different. You know, reinsurance strategies vary. In hedge fund, you know, likewise, hedge fund strategies are pretty different across the different spectrums. And because of that, we're not just going to apply a standard capital charge as we would with a hedge fund portfolio that only makes up a tiny piece of the investment portfolio for a traditional reinsurance company. So we'd have to do more of a bespoke analysis, bring in our asset team, and have a look at that particular portfolio and what are the actual risk characteristics in those portfolios. And then, you know, layering on top of that, we have to look at the management team, and as with any startup, we have to look at a 5-year business plan and really try to assess the quality of the management, the quality of the business plan, the capital adequacy of the business projected forward to really come to what we would think of a business like that. And our view is that, you know, the hedge fund reinsurance business model, you know, it certainly can be viable, but those investments consume a lot of capital. So, yes, you could potentially create higher returns on the investment side, but those higher returns are at the cost of capital. So kind of bringing the two together, are you getting a better risk-adjusted return with those kind of vehicles put together than maybe having them separate? And that's one issue that probably is not as discussed as much as we would like to see. Very interested to hear more thoughts on how the risk characteristics of these two different types of entities, and also the risk cultures, because you're bringing in two very different cultures together, and how they interact, and how that's creating a better, or creating value or better risk-adjusted returns for the investors. So, you know, those are just some of the thoughts that go into how we look at those models.
No, that's a great point, Jason. I think one of the other aspects, which I think was touched on in the last panel, which I would also echo, is the governance that's being applied. Our ratings are forward-looking, and so one of the aspects that we really need to get our arms around is what are the investment guidelines and the inherent flexibility that a hedge fund-backed manager has. And heretofore, I mean, that's something that, quite frankly, in a regulated insurance capital world, that's probably something that they haven't really ventured into. So part of it is an evolution of just how guidelines are developed and how they're executed. And so that's one area that we've been spending a fair amount of time on as well. So I'm sure this debate will continue throughout lunch and throughout the coming months. So more to come on that as well. Mike, you touched on this before in terms of key regulatory developments, and I know previous discussion people talked about last year was the talk around the flood as well as the terrorism. But if you could kind of give us an up-to-date view of where Endurance's focus is on in 2014. We know we seem to be coming to somewhat of hopefully a final close with respect to where the Terrorism Act, Renewal Act is going to end up. Still no final determination there. So where are your focuses is going to be in 2015?
Sure. I think a lot of those earlier discussions on TRIA or other flood or terror pools, those are, I think, a lot more focused on the underwriting appetite. Mm-hmm. If I think about the remit of a chief financial officer, I mean, it really is about capital requirements and regulatory compliance. So if you think about the global footprint that a company like Endurance has, we have regulators everywhere, then they all want their own reporting requirements. They all want their own version of economic capital. They all want their own version of a balance sheet that they can regulate and oversee. And so we're seeing the regulatory environment mushrooming from a compliance and reporting point of view. And I know the objective of global regulators are to see convergence. The reality is that's never going to happen in a way that actually works efficiently for a company that operates globally. Everybody's going to have a slightly different view, and so you end up having to tinker with your economic capital models, your regulatory requirements, to meet each distinct regulatory requirement. So the BMA is our core regulator here in Bermuda, and I think they've done a very admirable job of trying to converge their standards with what they think is coming from Solvency II and other global regulators, and they've taken a very pragmatic approach that I think has made Bermuda a continued domicile of choice for capital formation. We also have a London company that's regulated by the PRA, and I'd say they're at one end of the extreme in terms of the requirements. We all have our own economic capital models for internal management purposes, but what we're seeing out of the global regulators is a need to have a bespoke economic capital model that fits their purpose. And so you have your own economic view of the world, and then you have to create one for the BMA, you need to create one for the PRA, and ultimately the NAIC. And so those are all things that consume inordinate amounts of time and energy for finance departments globally. And unfortunately, I don't think that's not going to abate anytime soon.
Yeah, it's almost, to some extent, operationally, I assume you almost create a least common denominator, and then you kind of fit the needs of the requirements across the board.
Yes. Unfortunately, the least common denominator, or the highest common denominator of capital requirement, is typically the rating agency view of capital. So,
I'd echo a number of Mike's comments. One of the things that we're fortunately blessed with at Axis is that we don't have a lot of regulated companies across the world. 8 might sound like a lot to you, but I've worked for organizations that had far more than that, and frankly, the fewer the better. If somebody's coming to me today and asking to start a new regulated entity, they better have a very good reason. Frankly, we got into Lloyd's about a year and a half ago. That in our minds was a great move because, frankly, we can expand globally, through Lloyd's as opposed to starting up entities in a lot of the jurisdictions that Mike was referring to. But, and I'm not just saying it because I'm here, but we're blessed with a very good regulator here in Bermuda. Like Mike, we have regulators in London, Ireland, and several other jurisdictions. I have to say I'm a little bit stunned as to the capital requirements coming from branches of other legal entities. When I grew up, a branch was a branch of another company, and if the other company had the capital, that was fine. But now each country, when you establish a branch in it, is asking for its own capital, which to me is above and beyond where it needs to be. So I'd echo what Mike said, also what Kevin said. As much as I like the challenge, frankly, of capital deployment, I hate dealing with the regulatory side of the house, but frankly, it's in some ways a necessary evil. Convergence, I would also agree with Mike, very difficult to get that. But frankly, we deal with some of the strongest regulators in the world. And I think they're pretty practical about what they're asking for in terms of capital in their jurisdictions.
Joe, maybe we want to touch on the reserve adequacy. I know you'd mentioned the mix of business that you have, but a lot of times, we talk about reserve adequacy a lot when it comes to primary companies, but there is the issue as well for reinsurers. Can you talk about Axis's approach to the reserve adequacy, and maybe even touch on the element of the long tail segments, which at a rating agency we tend to look at pretty significantly, especially as you look at some of the later accident years development.
Yeah, so reserve adequacy, extremely important to the chief financial officer of a company. Want to make sure the assets are safe and frankly the liabilities are adequate. There is growing concern out there today that loss reserves are becoming less adequate. I think you see the amount of prior year development, favorable prior year development coming down. I think you see a number of companies actually strengthening reserves. I think that'll tell you kind of the condition that overall reserve adequacy in the industry is in. We maintain a pretty conservative stance on the reserving side. I think it's, people ask me all the time, do you expect to see the same prior year development that you've seen in the last couple of years? And generally, we don't get into projecting what that is, but I'd say the answer to that is probably no. Making sure that the reserves you're setting up on the business that you're writing today, the current accident years, is very critical. Right now, we're facing a little bit of pressure because our current accident year loss ratios are pretty high. We're going through some changes in our mix of business to lower volatility, which is causing some of that. But frankly, I think we're being very practical about what's happening in the market today. You know, if you look at pricing, and you heard this earlier on today, pricing is at or below loss trend. And that means one thing, that loss ratios are going to go up unless something else is going on. So frankly, I'm not surprised that accident year loss ratios as a company are going up, and I think it's very important to make sure that your current accident year is set at an appropriate level. And then frankly, in terms of prior year development, I think it's important to put that back into accident years 2011, 12, and 13, which a number of companies have seen, you know, loss ratios increasing. So, you know, we're very, very committed to making sure loss reserves are adequate. I think most companies in the industry are doing that, but we're starting to see some changes in that, and I just wonder what that means for the future.
Mike, any thoughts?
I would agree wholeheartedly. I'd make a comment about Bermuda in general. I think the Bermuda market, I'd say as a general statement, is very well reserved. I mean, fortunately, the volatility business that tends to find its way to Bermuda tends to have good margin associated with it, and when you have a reasonably benign loss activity, you tend to have pretty solid reserve strength. I think as I look back over the past underwriting cycle that ended pretty badly from a reserve development point of view, I think that was a lot of companies that just that kept going on with inadequacy in their reserving and never really dealt with it, never trued it up, never went back and, say, tweaked one accident year up and one accident year down to right set the reserves. And then what happened is that it just got to a point of no return, and then it just fell off a cliff. Mm-hmm. I think that the likelihood of that happening in this day and age, I think, is very low. As the chief financial officer of a public company, I need to sign every quarter that our financial statements are adequate and our disclosures are adequate, and there is personal consequences to getting that wrong. And so I think I would imagine Joe and other CFOs have a very heavy hand in making sure that the reserve levels that are set for current and for prior years are certainly adequate. We have a bias that we know we're wrong when we set our long-tail reserves. Mm-hmm. We'd like to be wrong on the prudent versus the aggressive side, and that's shown its way through over the years in favorable development. Is that going to continue at past levels? I agree with Joe, probably not. But I think the inherent bias that exists throughout most of the market is that there is a bias to conservatism, and I think that's appropriate, particularly as the markets are softening. And if you're not making sure that you reflect the current pricing environment in your loss picks, then I think you're going to have a day of reckoning pretty soon.
Okay. Jason, similar to M&A, a lot of times we do go out on the primary market side and talk about the expected decline in positive reserve development, and we always seem to be surprised when that development continues at a certain level. So can you just touch on, you know, overall view of reserve adequacy?
Yeah, we think reserves are adequate, and there's probably some redundancies left in there from some of those older accident years. We've said in the past, unlike many others, that we expect those reserve releases to dry up. And we still have an expectation that they'll dry up. It's not a if, it's sort of a when. Mm-hmm. So as those dry up, the question starts to become, are those current accident year picks as conservative as some of those past accident year picks are? And then when you're looking at forward results, if you don't have that benefit of reserve redundancies, what kind of loss ratios are we looking at? So that's a key question. I think if you start looking at accident year loss ratios instead of calendar year loss ratios, you might have a different view of how profitable the industry is, and then also recognizing some of the rate pressures that the industry is under. So it's something we have a close eye on. But our internal analytics that we've done, in addition to some of the third-party reviews that we've seen, our view is that overall we believe reserves are adequate at this point, and there's probably some redundancy left, but it's not nearly likely to be what it has been in the past.
Okay, if the folks can at least get a hold of some mics, our planners, turn over the tables to the audience here. We have two esteemed CFOs, as well as one of our rating analysts. So any thoughts that are coming from the audience? Don't be shy. Lunch is around the corner. All right. So I served at least the warning. I'll come back to you in 5 minutes. Don't let me down. In terms of, it's interesting, when we highlight this in a lot of our rating reports, but enterprise risk management is a clear strength that we see in the reinsurance industry. I think it's a focus of the reinsurance industry. Clearly, they're holding on to a lot of the tail risk, but they've been early adopters in a lot of the sophisticated techniques. One of the things that I think we heard this morning when Don Kramer was talking about the evolution of how reinsurance came is the fact that there's so much more talented, sophisticated individuals as well as techniques that are coming to the marketplace. So, of course, us being a rating agency, we always like to hear what's on the cutting edge in terms of developments on that front, or just trying to remain sustainable in terms of the effectiveness of the program. So either Mike or Joe, any thoughts in terms of how the evolution, continued evolution of the enterprise risk management program in your shop has continued to take hold?
Sure, maybe I'll start with a market commentary first. I think Bermuda does enjoy, perhaps it's, Bermuda is the spiritual home of enterprise risk management. The biggest risks in the world come to Bermuda to be covered. And so as companies were formed, there was with that critical insight that there is so much risk that is here. If you're not managing it, you're going to be destroyed. And so the company's DNA, at least for Endurance, is surrounded around risk management, making sure we have the right people to make underwriting decisions, that we have the right technology to analyze and understand very complex global risks, that we understand how risks play one with another, not just on the underwriting side, but with the asset side, and then how do you view operational risks. Those are all key elements as I think about risk management. And one of the key things, and I think within S&P's criteria, is how do you think forward? What are the things in the future that you need to prepare for? The unknown unknowns. I don't know what they are, but a key thing that companies need to do is prepare for the unexpected. And one of the easiest ways to prepare for the unexpected is make sure that you have more than enough capital resources, that you have a demeanor towards taking risks that tends to be more prudent, that you get enough risk margin in your business, that you set the right reserve levels, and that in every point in the process you're layering in a level of prudence that will help you withstand the mega events that happen. And that so when you look way out on the tail, that tail event might be very different than what you modeled, but you have enough other downside scenarios that have created a company and a balance sheet that can withstand those stresses. And companies need to make sure that their ERM process is set up in such a way that you learn from the past mistakes, because every event brings a new set of data, a new set of learnings that needs to be acted upon. And history will repeat itself, and if you don't learn from the lessons, you're doomed to repeat that history. And so we have a critical feedback loop in our enterprise risk process that we do a look back every year. We say what's happened, what was expected, what was outside of expectation, what do we need to change, what do we need to adjust, and that is a continuous flow. And with new and increasing technologies over the last decade, that process has only gotten better.
Thanks, Mike.
Yeah, I would jump in there as well with Mike. I mean, the importance of risk management today, can't really be overstated. The interaction between a chief financial officer, a chief risk officer, a chief actuary, and a chief investment officer is as close today as I've ever seen it in 40 years. The way we run risk management within our company is that we actually embed risk managers in our business, and we also have a holding company team that kind of oversees risk across the whole group. The importance of risk managers being accepted by the business people is really, really critical. If risk management is seen as an obstacle to growing the business, it's a real problem that you have within your company. Fortunately, we don't have that. Our business people embrace it. So before they go into anything, whether it's a new business, a derivation of an existing line of business, there's a really good dialogue between the risk managers in the business and the business people themselves. And just to add to what Mike said, we do a look back as well. I mean, companies make mistakes. Let's face it. You don't do everything perfectly, but you have to learn from your mistakes. I used to say that to my kids all the time. All right, you made that mistake once. Let's not do that again. And frankly, that's kind of how you run the business. So that's probably all I want to say.
Jason, maybe just point upon maybe some of the techniques that S&P look at, because we do talk about the sophistication of the models and the economic capital models. We talk about the regulatory developments. But is it fair to say that we also spend a significant amount of time on the qualitative and what experience people bring to the table in interpreting those results?
No, absolutely, and I think the Bermudian reinsurance market and the reinsurance market in general has been on the forefront of enterprise risk management within the industry. I think the reinsurance industry views itself as capital managers. They take on severity risks. They take risk management very seriously. And I think the forefront is the soft market pressures, or one of the frontiers in risk management is actually the testing the risk culture, those controls through the soft market, so they don't deteriorate because as the market pressures build, the incentives to relax your risk controls also build, and that's getting to Joe's point. Is the risk management function embraced throughout the organization? Does the risk management function have the influence throughout the organization to actually effectively manage risk? And those are probably some of the qualitative things that, especially in a market that's challenging like this, become more important.
Good. Interesting times, definitely interesting times. Again, opportunity. We've got about 10 minutes to go, so definitely want to, thanks, Brad.
Goes back to the issue of regulatory convergence. So some of the, as you know, the IIS is developing an international capital standard for the large insurance groups, and some of the regulators designing that standard want it to be a capital standard that replaces rating agency capital. So how would you all feel if really regulatory capital ended up being controlled by regulators rather than by rating agencies?
I don't know, better the devil you know than the devil you don't? I don't know. It's a good question, Brad. But the worry I would have is that regulation is politicized, and depending on who is the ultimate controller of that, and is that a stable controller, I guess I'd say it depends on who ultimately is making that decision. If it would rest with your host regulator, your home regulator, and that was accepted globally, I think I'd be happy to have a converged view of regulatory and rating agency capital, because they both do tend to focus on solvency, although I think the ratings would tend to also have a more of a going concern element to it than just pure solvency. I would welcome it. I think it's, I'll let the guys from S&P speak about whether they would accept that in terms of granting their ratings. We're in a rating-dependent business, so if the rating agencies were no longer to exist, if that's the ultimate outcome, I think the whole business needs to be readdressed in terms of how a customer gets comfortable with their risk capacity providers. And I think that's probably unlikely, but I'll turn it over to the other guys to see.
Yeah, I'd say the importance of S&P and AM Best to us as a business, whether it's U.S. or international, is critical. If we can find a better mousetrap than what exists today, fine. If we can't, I'd say it's not broken. So, do we really need to fix, what we have in place? Before I joined Axis, I spent more time on the operating side of a company than I'll call it the corporate side. And frankly, coming back into this about 2 years ago, I was pretty impressed as to how the rating agencies review companies. I mean, this is not a surface review anymore. I mean, this is a very complicated process that we go through. I'm sure, like Mike, I mean, we spend months preparing for our annual rating agency meeting, and we take it very seriously. And frankly, if there are any issues with any of those are taken very seriously as well by not only our management team, by our board. So I guess my short answer would be, if we can find something better than that, fine. But right now, I kind of like what we're doing.
Yeah, Brad, I would just say that the insurance industry, not only the geographical differentiation in terms of the products, the accounting, the various different regulatory regimes, creates a whole different element of what the international group is facing, and coming up with what I would call these global standards. One of the things that we're concerned about on the global standards is does that become the new norm, okay, for the companies that are not viewed as globally or being significantly, systemically important. So one of the aspects is we're very conscious of when those results come out or those factors come out. But I think in terms of where we are in terms of the entrenched view of the specific regions, I think that's clearly an advantage that S&P has. And the other thing, too, is we've been in looking at their economic capital models for companies for a number of years. And interestingly, we have an assessment of economic capital. We don't have our own. But it's really interesting to see how those results correlate to what we currently have, right? And that's something that I don't believe, and it's, and it's only because not only it becomes a resource constraint, but it hasn't necessarily been a focus of the international regulators. So I think we do have the foothold there. The interesting thing is when we went through the financial crisis recently, the recalibration that took place on the economic capital models across the industry was very, very telling. So it actually showed us that even the companies who are the best positioned to actually identify those risks still have a ways to go with respect to setting those assumptions. So I think I mean, we'd welcome, what they apply, but I also think that there's a large learning curve on that front as well. So more to come on that. Other questions out there?
I'm curious to know, there seems to be a slight difference in view in terms of having outside managers manage the investment portfolio. On the CEO front, it seems like it's more of an interesting pursuit versus the CFO front seems like everyone wants to shy away from the additional risk. How do you reconcile between the two?
Is it vision versus reality, maybe? No. I hope there's no CEOs in the room.
Yeah.
But,
that's why we went
so.
second.
My boss isn't here, so he didn't hear that.
Good.
I don't think there's a dissonance between the views of a CEO that may be very interested in it. I think the CFOs are probably approaching it from a practical point of view to say, well, what is the real opportunity, and are you appreciating the risk there? Strategically, I think there is a lot of merit to making sure that you're deploying your assets in the best possible way, and whether that means you're using an outside manager or an internal environment, or you have a broader strategic relationship. Personally, I'm pretty agnostic as to what you do. It really comes down to what's the risk, what's the return, and can we execute it? And so I don't see that there's a lot of dissonance. I unfortunately didn't hear the earlier panel, but I don't think there's a lot of dissonance in the points of view.
I feel pretty strongly that it's better to have your assets managed outside the company than inside the company for one very simple reason. The talent that you can attract within a company versus the talent that's embedded in investment management firms is like night and day. That's no offense to anybody that works inside a company, but I've worked for 4 insurance companies in my life, and I've had exposure to a lot of investment management firms. We use upwards of 25 different firms today on our portfolio, and it's only a $15 billion portfolio. But hands down, my answer would be outside investment management. My guess is that you work for an investment management firm. No, I'm only kidding.
We only use outside managers as well.
Right.
Yeah, from a rating agency perspective, I mean, I think really it gets down to risk appetite and what people bring to the table. But we're very conscious of the coordination. So in other words, how is that asset strategy developed? In a traditional insurance company and reinsurance company, it's basically driven by the liability profile. So to the extent that the asset strategy is deemed based upon level of expertise and it dominates the overall profile, we're going to have a number of questions on how that relates to the liability side.
I'll also just add, there are some assets that frankly could be managed in-house. I don't want to make it a universal rule. I think in some cases there are advantages to doing it in-house, but the vast majority of assets I would say would be better managed outside. Just want to clarify my position
there. Joe mentioned the planning cycle earlier, which got me sort of thinking. So we're sitting in a soft cycle, potentially softening cycle, and no underwriter, by nature, when every CFO says they want to write for profits, no underwriter really wants to shrink their line of business. It's not a case of sort of saying, put your hands up if you're willing to shrink your line of business. So my question was, how do you manage that conflict between planning loss picks for next year, writing for profit, versus what underwriters, they don't want to show that they're shrinking their line of business? So as you go into the planning cycle, how do you manage that?
Yeah, fortunately, I mean, first of all, I hate the planning cycle, but anyway, besides that, fortunately, we don't have a lot of business people that I think come to the table and say, you know what, I want to grow my business in an environment where they're not generating the appropriate profits and rates are going down. You just don't find that. There are a couple of situations where, you know, we just think from a capital deployment standpoint, we're better off putting our money somewhere else. And they have to just understand that it may not be their time to grow. And I think it's important for managements not to take it out on the underwriters, frankly, and just say, you know what, we're going to ask you to just park your business for a while. You know, keep your powder dry and return to the market when there are better market conditions. We had, and this is before my time at Axis, but we had a primary casualty operation. Frankly, the environment was so difficult, it just made no sense to write business. So we kind of shut down the operation. We kept the people. And frankly, when market conditions improved, we redeployed ourselves. Not easy to get in and out of markets, you know, on the primary side, a little bit easier to do that on the reinsurance side just by shrinking it. But I would say we don't have many, let's say, discussions, you know, where the underwriters just feel that, you know what, the direction I'm taking is different than maybe what the rest of the management team feels.
Mike?
I would just add that from a planning point of view, I agree that I'm not a big fan of the planning cycle, but it is a necessary part of the running the business. And collaboration is key to make sure that you have the underwriters, their point of view, that you have your pricing actuaries and your corporate risk teams all involved in that planning process so that you can take all things into consideration. And if you find that there's, you know, one louder than another, you need to make sure that there's enough balance of points of view that you come to what a reasonable outcome. And what we have found going through that in the times when we've had, you say, an underwriter that doesn't want to, you know, slow down their line of business or doesn't agree with a loss pick, if there's a lot of dissonance, you tend to find that there's an incompatibility in the culture of the company, and that has to be resolved. And we've generally seen those individuals out of the company if they're disagreeing with the corporate philosophy and the risk management and not accepting, say, the corporate loss pick.
But both of our CEOs in our businesses have basically said, to Mike's point, there is no difference between a reserving actuary's opinion of what a loss ratio is and a pricing actuary's opinion. And that really, by saying that, that brings the organization together. You don't have these situations where a different view of the business exists. If it does, that's a real problem.
Yeah.
We've got 1 minute to go. We can squeeze in one other question. I know we learned a lot of things this morning. We also learned about a lot of things that the CFOs look forward to doing and some that they don't look forward to doing. One thing that we actually do as a rating agency, we actually call each company up and say, we're not asking you to produce more reports for us. We just want to leverage the reports that you currently do for all your constituents. So we just try to make that pain be a little less painful going forward. But before I ask you to applaud for our participants here, I do want to let people know that during this close, there's going to be lunch served out in the garden underneath the tents. Hopefully the weather will cooperate. It looks like it's cooperating up until now. And then we're going to return back here for another session at 2 o'clock. So with that, could you please join me in thanking the panelists? Thank you.